Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about property, plant, and equipment, PP&E, and specifically about what kind of costs become part of our historical cost, or the amount of value that's capitalized into our asset account as opposed to debited immediately into an expense. We talked about how the main rule of thumb here is whatever we spend getting that asset ready for us to use gets capitalized. Everything else gets expensed. One of the major concerns with this process is deciding what, if any, interest can be capitalized. And we spent quite a bit of time talking about what interest can be capitalized, when it can be capitalized, and how we decide how much can really be capitalized. And in our last segment, we talked about IFRS and the fact that one of the very few differences in accounting for property, plant, and equipment under US GAAP and IFRS is how we capitalize interest. And then we went through a couple of examples to see the capitalization of interest under IFRS. Now it's time to turn our attention to a couple of other issues with capitalization, and we're going to start with basket purchases. A basket purchase happens when we buy a bunch of assets in one price. We can find examples of this everywhere. We actually do basket purchases all the time. You walk into a supermarket and you buy a shampoo conditioner combo. That's a basket purchase. 2 items for the price of 1. If you buy a home, you buy the land and the house that's sitting on that land. That's another example of a basket purchase. For businesses, of course, the stakes are a little bit higher. We're buying more assets. But if I go to auction and buy land in a building in a parking lot, well, now I've got at least 2 assets, maybe 3, depending on how you want to break it down. Or I go and buy a bunch of inventory in a big warehouse. Well, now I've got land and warehouse and inventory all wrapped up in one big package. So we have to decide from an accounting perspective, how do you allocate that purchase price to each of these different assets? Because unless they depreciate at the same speed, I got to break them up. And if there's any land in there at all, it doesn't depreciate, everything else does. Okay, I definitely have to break those out. So we've come up with a way that lets us break apart that purchase price and allocate it to the different assets within our basket. And here are our steps. First, we're going to go find the market value of each asset. What would we have paid if we bought them separately on the open market? And we can do this by finding similar assets that have a market price. We can bring in an expert that can give us a price value. So there's lots of different ways that we can come up with these market values. Next, once we've got the market value for each of the assets, we add them up and get a total market value for the whole package. And hopefully we look at that number and go, oh, we got a great deal. If we look at that number and go, man, that's less than I paid, then we blew it at the auction. The third step is we get a percentage. So I take each asset's market value and divide by the total market value of the whole package. And that gives me a percentage. And once I have a percentage, I can go back to my purchase price and say, all right, let's take this percentage, went to asset A, so I'll multiply my purchase price by that percentage, and that's the amount of cost I will capitalize for asset A. And I can do that for each asset that I've purchased. Let's take a look at an example of this. This is Hansen Company. They purchased a discontinued operation from a rival for $10 million, $3 million in cash, and then a $7 million note. The purchase includes the factory, the land that factory is on, a large set of equipment, and then some computers and other office assets or office furniture. If the information in this table are the market prices, by talking to experts in the field or going out and seeing what all these assets were worth, what we want to do is make the journal entry for this basket purchase. So step number 1 is to come up with the market price of these assets, and I've done that. So this column right here is step 1. And this total down here, that's step 2. Step 3 is to get a percentage. So I'm going to take the $2,250,000 and divide by the $11,250,000. And if I do that, I get 20%. Now I do the same thing. The $1,687,500 divided by the $11,250, I get 15%. 6.75 divided by the 11.25, I get 60%. And the 562,500 divided by the 11,250 is 5%. Now, you don't have to do this next step. I'm going to recommend that you do, because they're not all going to come out even like the way I've made them up for this problem. Oftentimes you're having to round these percentages, so please, before you finish, make sure that these add up to 100%. If they do, you're okay. If it's 99% because of your rounding and you don't catch that, your journal entry is not going to balance. And if you get 101%, again, it's not going to balance. So make sure, especially if you're having to round, that it comes out to the full 100%, or you'll be in trouble later. Step 4 is to get our historical cost. This is step 4. So to do that, I'm going to take the $10 million purchase price and multiply it by each of these percentages. So 20% of 2 million, or 10 million, is 2 million. 15% of the 10 million is 1.5 million. 6 million and 500,000. And as long as these percentages added up, you should add up to the $10 million. If you don't, then you've done something else wrong. So there's another check there. Now that I've got the amounts, I can do a journal entry. The best part. Let's take a look at our journal entry here. In this case, we've got land. We're going to debit that for 2 million. We have a building that will debit for 1.5 million. We'll debit our equipment account for 6 million. And office equipment or furniture, whatever you want to call it, 500,000. Must have either some really nice chairs or some good computers and servers in there. Otherwise, you probably overpaid for the whole furniture thing. So let's see, we paid 3 million in cash, and then we issued a note for the balance. That's in that first bullet point back on the question slide. Record basket purchase of property, plant, and equipment with 3 million cash and a $7 million 6% 5-year blah 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 note. And I put in all those details about the note and when it has to be paid and all that kind of thing, so that I know as I move forward I can calculate all the interest and the other things that go along with that note. So that's our calculation for a basket purchase. Not difficult, just something that you need to make sure you're comfortable with so that you know what you're doing. Let's talk about a couple of other conceptual issues now that go along with our PP&E. First off, just be aware, if a discount is offered by your supplier, you have to reduce the value of your PP&E by that discount. Even if you don't take the discount, you still have to reduce the value of your PP&E. And this goes back, you may remember me talking about discounts and how big of a deal they can be. One of my first accounting teachers, matter of fact, my very first accounting teacher, worked for a company that used a lot of mining equipment, very expensive stuff, and the discount was a multi-million-dollar discount because the equipment they had purchased was so expensive, and the whole department shut down. And this is part of the reason why. If they had not gotten that discount, they would have had to expense that amount because the equipment itself had to come down by that 2% discount. So that was another reason why they had to find that bill and get it paid in time. Next, assets purchased using debt are recorded at the present value of the payments that will be made. So we did present value calculations of notes as part of Chapter 7. Just be aware, we would calculate the present value of all these future payments, and that's what we would put in as the value of the asset. And as we go through and actually make our payments on this debt, all of the interest that builds that back up, gets rid of its premium or discount and gets it to its face value, all of that interest has to be expensed because we're out of the capitalization period, even if the asset qualifies. So we can't use that interest to beef up our assets. It's just going to be expensed right away. The last major issue, as far as new acquisitions go, is when we use stock to buy an asset. And this happens quite regularly, especially for new companies. Instead of issuing cash to our vendor or taking out a note that we may or may not have cash for, we'll give them stock in our business. And if we give them stock in our business, the rule is you don't go to the market and say, well, the stock is selling for $5 a share, and we give them 10,000 shares, so the equipment's worth $50,000. Instead, you say, well, the equipment retails for $45,000. We'll put the $45,000 in as our equipment, and we'll say that the stock is worth that $45,000. We'll talk about stock more in Chapter 15. That'll click a little bit more then, but just be aware, we use the value of the asset received for the stock, not the value of the stock for the asset. There is one exception to that, and I don't like to talk about exceptions, but just be aware, the exception is if there is no market value. It's a one-of-a-kind asset. We have no idea what a market value would be, not accurately, no good estimate for it. In that case, I would use the value of the stock just because I can't come up with an estimate for the asset, so I have to go the other way. Let's take a second and talk a little bit about costs after acquisition, subsequent costs. And the issue here is that we often make repairs or improvements to our property, plant, and equipment. We have to keep them running and keep them functioning the way we need them to, or we may need to upgrade them a little bit and get them moving faster. The rule here is that we can capitalize these repairs and improvements if and only if one of the following three conditions are met. First, we improve the useful life of the asset. We make it so we can use it for 10 years instead of just 5 more. We've revitalized it. Number two, the quantity of units the asset can make gets bigger. So, we built this machine to produce widgets, and we thought it could make 100,000 widgets, and now, we're down to the last 10,000, and we think it'll be useless. But if I put in this new motor, I can probably make another 50,000 widgets. Well, 10,000 to 50,000 improves the quantity of units I can make, so I could capitalize the cost of that new motor. The last one is I can produce better units. So if I've got an older machine and it's producing units that really are not up to par, and I'm having to throw a bunch of them away, and I do an improvement and pay some money to get new parts added or revitalize the machine, and now I'm throwing away 100 units instead of 1,000 units with every batch, then I've improved the quality and I could capitalize the cost of that repair. Now again, why would I want to capitalize them? Well, I capitalize them because if I capitalize them, then I don't have to show them as an expense right now. And some of these repairs can be very expensive. If I show them as an expense, it's going to drop my net income, hurt my earnings per share, it makes me look like I'm having a bad year. If I capitalize it, then it becomes part of the asset value, and I depreciate it over 10, 20, 30, whatever years, and it smooths that out so I don't get hit as hard on my income statement. So for a lot of companies, especially for big amounts, they want to capitalize if they can. If it's a small amount, it's usually not worth the hassle. If we're talking about a $500 or $600 repair, it's not worth the hassle of capitalizing it and then having to figure out depreciation over the next 5 years on $500. Let's look at some specific examples of this. I like to think about this in terms of my car for most of these. It's easy to think about it that way. So if I take my car in for an oil change, then it's an ordinary cost. It's not going to improve the value of my asset. It's not really going to lengthen how long I can use it, at least not substantially. That's an expense. I couldn't capitalize that. It's an expense. If it's a major repair, like installing a brand new engine, then that gets capitalized because I've improved the life of my asset. I have to stop right here and tell you a story. Every time I teach this concept, my thoughts go back to a student car in every sense of the word that I owned when I was working on my PhD. I had purchased it at auction, and it was kind of a fluke that my wife and I bought it. We both thought the other one wanted to buy the car, and so we bid because we thought the other person wanted to. We didn't want to. We thought the other one did. And we ended up buying it. It was only like $300. It was an old student driver car. It looked awful. But after a couple of years in Georgia, it started to wear out, and it had some problems. And I took it into a mechanic. And this is in Georgia, so we're talking deep south. And I get a call from my mechanic, and he says, "Well, is that your little Dodge Spirit?" And I said, "Yeah, that's my Dodge Spirit. What's going on?" He said, "Well, I'll tell you. You either need to junk her or sell her to someone you don't like." That was his answer after looking over my car. So I contacted my dissertation advisor and I sold her. No, I didn't do that. No, really, I went and picked up the car, and I was just honestly praying, can I just get to the junkyard? That's it. That's all I'm asking for. And sure enough, it literally drove from the mechanics to the junkyard. I weighed myself on the scale, or weighed the car on the scale, drove it down. It petered out as I got to the end of the hill. I got out, walked away. I got just enough in, scrap metal money to pay for the mechanic to tell me to junk it and take my wife to dinner. That was it. That's the end of my story. But yeah, that was his answer. You either need to junk her or sell her to someone you don't like. If I'd repaired it, then it would have been a major repair. I could have capitalized it. But in my case, it was better to just get rid of this old car. A couple of other examples. First, additions should always be capitalized. So if I'm adding extra rooms or expanding my equipment, adding on 3 or 4 new lanes or conveyor belts, then that would be treated as an addition. It would be capitalized, sometimes capitalized separately and amortized separately if it could stand on its own. If not, then we add it in and depreciate it just like we do the other part of the asset that we've added to. Improvements and replacements are typically treated as brand new assets as opposed to being capitalized into the value of an old asset. Now, just to be clear, an improvement is when we buy a newer version of an old asset. So I go from a conveyor belt that moves at 20 miles an hour, I don't know how fast they move, to one that moves 40 miles an hour. It's sleeker, it doesn't catch and rip off my employees' fingers or something, I don't know, whatever it is. But if I buy a newer model, that's an improvement. I treat it like a brand new asset. If I replace the asset, so I go from this delivery truck that's a 2006 to a new one that's a 2014, I haven't really improved anything, I can't go any faster, I can't haul any more product, I just got a newer truck that's not going to break down as much. That's a replacement. And both of those, we just write off the old machine and add on the new machine. A lot of information. Again, there's just a lot involved in deciding, can I capitalize this or not? And the rules are pretty explicit. We have to be really careful when we're capitalizing. For the very reason that companies want to capitalize, FASB's put limits on it, because we don't want people capitalizing everything and leaving nothing in the expenses, because then they're hiding stuff. And I will just mention, it turns out that a lot of frauds end up being based on capitalizing things that shouldn't be capitalized, or not reporting expenses that should be reported. So this is actually a fraud warning sign when a lot of stuff ends up being capitalized instead of written off. Well, we've talked about a lot in this segment. Last thing we need to talk about in this chapter or this lecture is what we do when it's time to dispose of assets. And we'll start talking about that next time. I'll see you then.